Every year, the world's wealthiest families transfer staggering sums of money into entities that carry names like foundation, trust, and institute. These transfers are reported in the press as acts of generosity. Magazine covers celebrate the donors. Politicians thank them in speeches. News anchors use words like selfless, visionary, and historic. But if you look at the actual mechanics of what is happening, a very different picture emerges. The money doesn't leave the family's control. The assets don't get redistributed to the poor. The power doesn't diminish. In many cases, it grows. A foundation is not a charity in the way most people understand the word. It is a legal structure. It has specific rules, specific tax advantages, and specific mechanisms that allow wealth to be preserved across generations, while simultaneously reducing the tax burden of the person who created it. The word philanthropy suggests giving things away. But inside the foundation system, very little is actually given away in the traditional sense. What happens instead is a complex reshuffling of ownership, control, and reporting categories. The donor transfers assets to an entity they still influence. The entity then holds those assets, invests them, and distributes a small fraction each year according to rules that the donor, or the donor's family, largely defines. The public sees headlines about billion-dollar gifts. What the public rarely sees is the tax receipt, the estate planning memo, or the investment strategy that sits behind those headlines. To understand the real purpose of foundations, you have to stop thinking of them as acts of kindness and start thinking of them as financial instruments. Once you make that shift, everything else begins to make sense. The legal concept of a private foundation is a relatively modern invention, but it didn't come out of nowhere. It emerged at a very specific moment in history, when industrial wealth in the United States had grown so large that its owners faced two simultaneous problems. The first problem was political. Public anger toward monopolists and industrialists at the turn of the 20th century was intense. Names like Rockefeller, Carnegie, and Morgan were associated with strikes, price fixing, and ruthless business tactics. The second problem was financial. Once the federal income tax was introduced and then steadily expanded, and once the estate tax began to bite into family fortunes, the wealthy faced a real threat to their ability to pass wealth to their children. The foundation solved both problems at once. By transferring assets into a foundation bearing the family name, an industrialist could simultaneously soften public perception and shield wealth from the tax authorities. The foundation could fund libraries, universities, and medical research, generating favorable news coverage for decades. At the same time, the assets inside the foundation would compound tax-free. The original donor would receive a deduction against their income tax in the year of the gift. Their estate would avoid taxation on those assets when they died. And because the foundation could legally exist forever, the family's influence over how that money was deployed would extend far beyond any single lifetime. This was not an accident. The lawyers and accountants who designed these structures understood exactly what they were building. They were building a vehicle that converted one form of capital, cash and stock, into another form of capital, which was reputation, influence, and permanence. The tax code made it possible. The public relations benefits made it attractive. And once a few prominent families adopted the model, every other family of similar wealth had a strong incentive to follow. Because refusing to use the foundation structure meant accepting a much higher effective tax rate than their peers. To understand why foundations are so powerful as financial tools, you have to understand what actually happens when someone gives assets to a foundation they control. Imagine a founder who owns $1 billion worth of stock in a company they built. If they sell that stock, they owe capital gains tax. If they keep the stock and it pays dividends, they owe income tax on the dividends. If they die holding the stock, their estate owes estate tax on the full value. Every path leads to a significant tax liability. Now imagine they transfer that stock to a private foundation bearing their name. In the year of the transfer, they get a substantial income tax deduction based on the value of the stock. The stock itself is no longer part of their taxable estate, so when they die, no estate tax is owed on those assets. While the foundation holds the stock, any dividends and capital gains accumulate inside the foundation at a minimal tax rate, usually just a small excise tax on investment income. Compared to the rates that apply to individuals and to ordinary corporations, this is an enormous advantage. Over decades, the difference compounds into something extraordinary. The foundation is legally required to distribute a certain percentage of its assets each year for charitable purposes, typically around 5% in the United States. But here is the key detail. The foundation can count many different things toward that 5% requirement. It can count grants to other charities. It can count administrative expenses. It can count salaries paid to family members who serve as officers or directors. It can count travel, conferences, and office costs. In many cases, the actual amount of money that reaches independent charitable recipients is smaller than the headline distribution figure suggests, and the other 95% of assets continues to grow inside the foundation, tax-advantaged, year after year. The net result is a structure that looks like generosity on the surface, but functions in practice like a permanent tax-advantaged investment vehicle. The governance of private foundations is where the illusion of philanthropy becomes most visible. When a regular charity receives donations from the public, that charity has a board, a mission, staff, and accountability to the donors and to regulators. If the public stops supporting it, the charity shrinks or disappears. A private foundation operates under entirely different rules. The founder sets the mission. The founder chooses the initial board. The founder's children or chosen successors typically continue serving on that board. The foundation does not need to raise money from the public because it has a permanent endowment seeded by the original gift. This means the board is not accountable to outside donors because there are no outside donors. It is not accountable to the market because the foundation is not selling anything. It is not accountable to voters because it is not a government entity. Its only real accountability is to the tax authority, and the rules that the tax authority enforces are relatively narrow. As long as the foundation distributes its minimum annual amount, avoids self-dealing that crosses certain legal lines, and files its paperwork, it can operate for decades without meaningful external oversight. This governance structure has profound consequences. It means that a single wealthy family can lock in a particular view of what counts as good for society, and then direct money toward that view in perpetuity. It means that staff, partner organizations, and grant recipients all become financially dependent on maintaining good relationships with the family. It means that fields of research, policy advocacy, and cultural production can be quietly shaped by private preferences that never face democratic scrutiny. The founder has effectively created a small, privately governed institution with the tax benefits of a charity, the permanence of a corporation, and the political flexibility of a personal office. And because the structure is entirely legal and widely used, almost no one questions it. One of the most important mechanisms inside the foundation system is the relationship between foundations and the businesses the founders still own. In many cases, a wealthy family does not transfer cash to their foundation. They transfer shares of their operating business. This has significant implications that are rarely discussed in public coverage. When a foundation holds a large block of stock in a privately controlled company, several things happen at once. The family keeps effective control over the business because voting power can be structured through trusts, dual-class shares, or board arrangements. The foundation has a strong incentive to support the long-term health of that business because its own endowment depends on it. And the family can arrange for the foundation to receive shares in ways that minimize the tax impact of succession, particularly when a founder is preparing to retire or pass control to the next generation. There are legal limits on how much of a business a foundation can own. But these limits are often less restrictive than outsiders assume. And there are various planning techniques that allow significant ownership stakes to remain inside the foundation structure for long periods. The consequences are worth sitting with. The public sees a foundation giving grants and funding programs. What the public often does not see is that the foundation is also a major shareholder in a specific company, which means the foundation benefits when that company does well and suffers when it does poorly. The family, serving on both the company board and the foundation board, sits on both sides of that relationship. Decisions about dividends, share buybacks, acquisitions, and strategic direction can all influence the foundation's capacity to give. This creates a tight feedback loop between private business interests and public-facing charitable activity. The two are not separate domains. They are deeply intertwined, and the foundation structure is what allows that intertwining to persist across decades and across generations. If these financial mechanisms are starting to feel less like generosity and more like architecture, you are exactly where this channel wants you to be. Ledger Cipher exists to break down the hidden structures of modern money, the legal frameworks, the tax code, the institutions that quietly shape who ends up wealthy and who does not. If you want to keep seeing the system the way it actually works, rather than the way it is presented on magazine covers, take a moment now to subscribe. Hit the bell so future breakdowns reach you directly. Every subscriber makes this kind of deep work sustainable, and it costs you nothing. The tax deduction a donor receives when they fund a foundation is often larger and more strategically timed than outside observers realize. Wealthy donors rarely give cash. They give appreciated assets, meaning stocks, real estate, or private company shares that have grown significantly in value since they were originally acquired. When these appreciated assets are transferred to a foundation, the donor typically gets a deduction based on the current market value of the assets, not the original cost. And at the same time, because the assets are being donated rather than sold, the donor avoids paying capital gains tax on the appreciation. This double benefit is enormous. Consider a founder who bought shares decades ago for very little and now sees those shares trading at many times the original price. If they sold the shares, they would owe capital gains tax on the full appreciation. If they instead donate the shares to their foundation, they skip the capital gains tax entirely and also receive a deduction for the full market value against their ordinary income, subject to certain limits. The effective subsidy from the public, through the tax code, can easily exceed half the value of the gift. In other words, for every dollar that flows into the foundation, a significant fraction represents tax revenue the government would otherwise have collected. The donor is celebrated for generosity, but a meaningful portion of the gift is effectively funded by the broader tax-paying public. This is not a minor accounting footnote. It is the core economic logic of the system. Tax-advantaged giving allows a donor to convert a large private tax liability into a large private institution bearing their name. The cost of that institution is shared with every other taxpayer in the country. And because the foundation can outlast the donor by decades or centuries, the influence purchased with that shared cost extends far into the future. The language used to describe foundation activity is a critical part of how the system maintains public support. Every document produced by a foundation, every annual report, every press release, every grant announcement uses a specific vocabulary. Money given out is called support or investment. Recipients are called partners or grantees. Programs are described in terms of impact, mission, and leverage. This vocabulary frames the foundation as an active agent of positive change, constantly deploying resources toward clearly defined public goods. What this vocabulary obscures is the structural position the foundation occupies. A grant is not a neutral transfer. It is a conditional payment to an organization that must align its activities, reporting, and often its strategic direction with what the foundation wants to fund. A multi-year grant creates an ongoing relationship in which the recipient organization adapts itself to the foundation's priorities, because losing that funding would threaten jobs and programs. Over time, entire fields of activity, whether in education, public health, journalism, or policy research, can become shaped by the aggregate preferences of major foundations. This shaping is usually not the result of a single directive. It emerges from thousands of individual grant decisions, each rational on its own terms, that collectively steer a sector in certain directions and away from others. The foundation rarely has to tell an organization what to do. The organization adapts in advance, writing proposals that will appeal, hiring staff who can speak the foundation's language, and emphasizing metrics the foundation cares about. Viewed in this light, a foundation is not just a distributor of money. It is a powerful signaling institution, and the signal it sends determines which ideas get resourced, which projects get built, and which alternative approaches quietly disappear for lack of funding. The international dimension of foundations adds another layer of complexity. As wealthy families increasingly operate across borders, the structures they use to hold philanthropic assets also become international. Some families use foundations based in jurisdictions with favorable legal frameworks, including certain European countries, and small financial centers, where trust and foundation law is especially flexible. Others operate multiple foundations in different countries, each with its own legal personality, its own board, and its own relationship to local tax authorities. The combined effect is a network of entities that can hold assets, move funds between jurisdictions, and support causes aligned with the family's preferences, all while taking advantage of the most favorable rules available in each location. Cross-border philanthropy is often genuinely useful, especially when it supports global health, disaster response, or scientific research that benefits from international collaboration. But it also creates complications for oversight. A foundation operating in multiple countries is subject to multiple regulators, none of whom sees the full picture. Assets can be held in one jurisdiction, decisions made in another, and grants dispersed in a third. For a family motivated primarily by generosity, this complexity is simply a cost of operating at scale. For a family motivated primarily by tax and control optimization, this complexity becomes a feature because it makes the overall structure harder to scrutinize. The result is that very large international foundations can direct significant resources towards specific policy areas, such as global agriculture, pandemic preparedness, or energy transition, in ways that influence national governments and international institutions. These foundations often operate with budgets comparable to small countries, and yet they are governed not by voters or legislatures, but by a handful of trustees chosen by the founding family. The combination of scale, permanence, and limited accountability makes the International Foundation one of the most potent private instruments in modern economic life. Defenders of the foundation model often point to genuine achievements. Foundations have funded breakthroughs in medical research, supported major cultural institutions, helped eradicate diseases, and provided critical early-stage funding for ideas that governments and markets were slow to recognize. These contributions are real and should not be dismissed. The more interesting question is not whether foundations do any good, but whether the system produces the best possible allocation of resources compared to alternatives. Consider what would happen if the tax subsidies currently embedded in the foundation system were collected as normal tax revenue instead. Those funds would flow into public budgets, where they would be allocated by elected representatives through democratic processes. Some of the money might go to the same causes foundations currently support, such as research, education, or public health. Some might go to priorities that voters care about, but wealthy donors do not, such as housing assistance, infrastructure, or direct income support for low-income families. The allocation would be messy, politically contested, and subject to all the usual flaws of democratic decision-making. But it would be accountable to the public in a way that foundation spending is not. The foundation model effectively substitutes the preferences of a small number of very wealthy families for the preferences expressed through democratic institutions. Whether that substitution produces better outcomes depends on your assumptions about elite judgment versus public judgment, about long-term thinking versus short-term pressures, and about the legitimacy of private power in a democratic society. These are not technical questions. They are deeply political. And the foundation system, by operating quietly inside the tax code, has largely avoided being treated as the political arrangement it actually is. So when you next see a headline announcing a billion-dollar gift, a new foundation, or a major philanthropic initiative, try to read it with different eyes. Ask who is transferring assets, what those assets are, how the structure is governed, and which tax liabilities are being reduced in the process. Ask how the foundation will be staffed, who will sit on the board, and how long the family intends to retain influence. Ask what fraction of the announced gift will actually reach independent recipients each year, and what fraction will remain inside the endowment generating investment returns. These questions do not make you cynical. They make you literate in the actual mechanics of wealth. Private foundations are not pure acts of kindness, and they are not pure exercises in tax avoidance. They are hybrid instruments that combine elements of both, along with elements of succession planning, brand management, and political influence. Recognizing this complexity is the first step toward understanding how modern capital actually reproduces itself across generations, and how the language of philanthropy obscures structures that would otherwise be much more controversial. If this breakdown changed the way you see the foundation system, the next step is to understand the related structures that work alongside it. On this channel, the video on how billionaires use trusts and holding companies to keep control while appearing to give things away is the natural companion piece. It goes one layer deeper into the mechanics shown here, and it will sharpen everything you have just learned. Watch that video next and keep building the map of how hidden financial systems actually work.